Hey everybody, this is Sharon. I thought I'd come at you today to talk a little bit about a question that I've gotten a couple of times. So the question is, hey, I've just been hired to do a cleanup for my company. What do I do? Where do I start? And so at first, the question really struck me as a little bit odd because when you say to do a cleanup, it's actually not like a one particular thing that you do, but it's a process that you do. So let me share my screen real quick. I've got a couple of points that I just kind of wanted to bring out here. So let's take a step back. When somebody talks about doing a business cleanup, what they're really talking about is doing an account reconciliation. And what an account reconciliation is the process of comparing the company's ledgers with source documents to ensure accuracy, to verify completeness and reliability of the account balances. So, what you're basically trying to do is you're taking what the company has recorded and you see what it's missing or what if something is recorded inaccurately or so forth. So, again, don't get hung up on the word cleanup. Understand that what they're asking you to do is basically do an account reconciliation of all of their accounts and make sure it's correct. You do this by checking the details against third party data and systems and supporting documents and bank statements and so forth. And this is what helps you detect discrepancies and to help prevent fraud or prevent an inaccurate financial statements from being recorded and sent out. So there are three types of reconciliations that you can do. So actually there's five types, excuse me. So the primary kind of reconciliations you do is you do a bank rec, you do vendor reconciliation, you do business specific reconciliations, intercompany recons, and customer recons. So basically, what you're talking about is okay, so the bank reconciliation is you're looking at bank statements and you're making sure that what you have recorded in your books is correct. It agrees with what the bank says. Vendor reconciliations is simply saying, do you have all of your bills recorded? Is everything, all expenses recorded that should be for the period? A business reconciliation is looking at the various accounts within the financial statements and just making sure that they're accurate. And there's some steps that you can go through to make sure that they're accurately recorded. So if a company has more than one account or more than one company is under an umbrella, then you would do an intercompany reconciliation. So if one company says, "Well, I paid company X amount of money," then company X needs to be recorded that they have received that kind of money. So that's all that is. An intercompany is saying if one company says something, the related company says the exact same thing. And then there's the final kind of reconciliation is a customer reconciliation. That's basically saying, do you have all of your receivables? Do you have all of your invoices? Do you have all of your sales recorded? So, how exactly do you reconcile an account? So, for instance, like say you're going to do a bank reconciliation. What you do is you're matching the cash balances on the balance sheet to your corresponding bank statement to determine if there's any kind of differences and to make any kind of adjustments that's necessary, either with your accounting records or even with the bank, because the bank may have something that may not have something that you have recorded. So, another question that I got was, do you reconcile expense accounts? How do you do that? And you do not really reconcile an expense account per se. Most of the reconciliations that you do is usually for all of the asset, liability, and equity accounts. So, since these are account balances that continue for many years, this is where you spend your time doing. So, it's less common to reconcile like a revenue and expense account because at the end of the year, these accounts close out to the equity account. And usually, if you go through the balance sheet accounts, basically the expense and the revenue shake out. For instance, if I'm looking at accounts receivable, the sales will shake out. The sales accounts will shake out because if your accounts receivable is showing that things are not recorded or you've got too much recorded, then that means that something happened with your sales. So that's why you primarily spend your time looking at the balance sheet accounts. So at month end, The types of account reconciliations that you do is you look at incoming cash, you make sure that funds you received were recorded correctly. You make sure that loans are recorded and revenues are recorded correctly and invoice payments are made. You review the accounts payable account. You reconcile whatever accounts that are on your balance sheet. You reconcile petty cash. That's something that a lot of companies don't really have a whole lot of. We've kind of gotten away from that when everything is done bank to bank now. You look at your fixed assets and your inventory, and then you put together your financial statements and then do a final review. These are the kind of things that you do at the end of the month to make sure that your books are correctly stated. So, what are the common errors that you see occurring in accounting? So, they fall into 10 different categories. So, you have data entry errors. That means that somebody fat fingered something. You have omission errors. That means that you left out a bill or you left out an invoice or something was left out in error. You have duplication errors. So that means like maybe you posted an invoice twice or you posted a check twice. Something got in the bank account or in the financial statements twice. You have transposition errors. So that usually means that instead of doing something as a debit, you did it as a credit. So the statement or the account is misstated. There's compensation errors. So these are things that you have recorded in your payroll incorrectly. Principal errors, that means that perhaps on your financial or in your loan that you have recorded a loan incorrectly. You didn't record the interest that's due or paid or so forth. Then there's entry reversal errors. So sometimes you make a journal entry in one period that should be reversed in the next period, and somehow it forgot to be reversed, and therefore your bank accounts or your statements are overstated. And then there's closing errors. That means that perhaps that you're going from a cash basis to an accrual basis at the end of the period. And as part of your closing entry is to make sure that you record your depreciation, your accumulated depreciation, record any accruals that are out there. And so those are called closing errors. And also another type of closing error is that you're missing items in a particular period. So let's say, for instance, we get to the end of the month and normally you would pay your rent, but you didn't receive a bill. So if I close the books for the month and not record an accrual and expense for that rent, that means that this period is misstated. It's a closing error. It's a period adjustment that needs to be made. Now, the most common reconciliation that you will do is a bank reconciliation. And most small businesses, this is where you kind of start. So you start by getting the bank records. You get the bank statements. If they have multiple statements or multiple credit card statements, you get those records from the source. You gather the business records, whatever they can provide you that'll show, what expenses, what checks and so forth, what invoices were recorded during the month or should have been recorded in the month. And that's where you basically start, right? Then you go to your bank deposits. You make sure all of the deposits that the company says was recorded in the bank. Any withdrawals that the company says is recorded in the bank and vice versa. You just basically breaking down and looking at each type of transaction within your bank statement. Then you kind of go to your books and you're looking at your income and expenses. Are all of your invoices recorded? And you would know that by if you got cash in for the month and you don't see an invoice in the books, you know that something was missed that way. Then you adjust the bank statement, you adjust the cash balances, and then you compare the balances. So manually, this is what it would look like. So you start with the balance per the bank statement. You add any kind of checks that were deposited but haven't cleared. You would look at any checks that were issued but hasn't cleared the bank. Sometimes there can be a timing difference, even with ACHs. Most people don't write checks anymore, but they do ACHs, bank-to-bank transfers. There still can be a 1 to 2 day lag between when something is recorded and something is actually leaves the bank. Then you come to the adjusted bank balance. From there, now we look at the company side of things. So the company has recorded 120,000 in their books for that bank balance. But we know that there's some things that happen in the bank that we didn't record on the books. So for example, interest received, $200. So the bank has said that we have given you interest, but you didn't record that entry. So this is an entry that needs to be made on the books. Another type of item goes the other way. So they're bank fees. So the bank statement is saying, oh, we had $750 of bank fees, but you haven't recorded that in your book yet. So you would need to make these adjusting entries in your books. And then you come to the adjusted book balance. This adjusted book balance should agree with your adjusted bank balance. And that's basically the gist of doing a bank reconciliation. So let's look at what causes the bank reconciliation to be out of balance. One of the most common causes of a bank reconciliation error is missing a duplicate transactions. Let's say that you have recorded a check multiple times, you've recorded an invoice multiple times, you've recorded a deposit multiple times, or vice versa, you're missing a deposit, you're missing recording the bank fees and so forth. So these are the type of errors that you would find that would cause your bank reconciliation to be out of balance. So real quick, I'm not going to spend a whole lot of time in this video on the QuickBooks, but it's very simple to do the reconciliation in QuickBooks. You just basically go to the banking menu, you select reconcile, you select the account that you want to reconcile from the drop-down menu, you put in the date, the bank statement date, you choose the statement from the date from the financial statements that you selected, and then you put in the ending balance on the banks that you received from the bank statement. And from there, you just check things off. It's either in the books and recorded correctly, or it's not. Very simple to do a reconciliation in QuickBooks. So that's all I really have to say today. I hope that kind of cleared things up. So when somebody says to you, I've got a cleanup to do, don't let it shake you. All it means is that you've got a bunch of reconciliations to do, and then you just take it piece by piece, take your time, eat that elephant one spoon at a time. This is Sharon signing off for today. Talk to you guys soon.